Unless you've been living in a cave, you've noticed markets are volatile.
Have you thought about selling out?
Don't. Hello from the Financial Consulate. I'm Roger Bair.
I'm Jackson Courtney, and this is Weathering Market Volatility with Your Retirement Portfolio.
Yeah, if you haven't noticed, markets have been a little volatile in 2025. Jackson?
Yeah, a little is a nice way to put that.
Yeah, so we got to figure out, okay, now that markets have been volatile, what do we do? How do we respond?
That's right. And we've gotten a lot of client questions. Should I be selling out? Should I modify my investments? What's the market going to do even? These are all kind of questions that we've been receiving and thinking about.
So should you look for hot ideas in the Wall Street Journal?
I'd think not.
No, I don't think so. Should you do nothing? Do something. Do anything. Jackson.
I don't know. We're going to talk about it.
All right, let's do.
So first off, this is a good one.
This is a good one.
Where we get a lot of our questions, where does it stem from?
The news.
It all stems from the news.
Aren't they helping us, Jackson? They're helping us. No,
No.
they're not helping us.
No.
Yeah, they are not helping us. Why aren't they helping us?
Well, you see, the news really is inclined to make you get emotional about what they're talking about. They, in other words, they are almost enticing you to make a decision.
Short term.
Short term.
They want you to focus on the markets short term, and that's exactly what we should not be doing.
That's right.
We should not be focusing short term. I think we gotta remember what they are trying to do. They have an economic value which is derived from us watching now, and them saying to us, "Hey, you got to pay attention to us. You got to trade the markets now,"
That's right.
which is completely the way not to go. So, as the slide says, turn off the TV. So markets are volatile. And so where do we start? What do we do?
So really, we start from building the portfolio to withstand these periodic bouts of volatility. Our goal, as an investment team, our goal really boils down to risk management, and we have to, at all times, think about volatility in the portfolio, not just when markets are going up, but in years like this year when they're going down.
That's exactly right. So market volatility arises unexpectedly. It's a fact of life. If you're in the markets, expect volatility. So what do we do?
So we have to think about risk tolerance, and we have to think about risk capacity. And if you think about it, risk tolerance is the risk that you can stomach. What's going to allow you to sleep at night? What kind of stock bond mix and what kind of percentage volatility on any given day is going to let you sleep at night? And then the second thing, risk capacity. Risk capacity is the most risk you can afford to take. Planning for risk in your portfolio to say, here's what I need long term. How much risk do I need in order to meet my goals? Do I need to take 100% stock risk that'll keep me up all night in order to meet my goals? If not, then think about lowering your risk.
If when the markets are volatility, like you can see on the slide, and clearly you can see from the slide markets are volatile, if when markets are volatile you feel emotional about it, what that means to me is your portfolio is not tuned correctly in accordance with your risk tolerance and your risk capacity. That means you need to start from the ground up and rework your portfolio and take a fresh look at your investment objectives. Now, investment objectives have components. What are investment objectives composed of? How do you look at this? And as you can see on the slide, it's your expected return. How much return do you expect? And the corollary to that, or the other side of the coin to return, is risk, right? They're mirror images. Taxes, time horizon, what else, Jackson?
We want to think about income or liquidity, and really that comes from, again, your retirement income needs. And like Roger said, as we think about needing a higher expected rate of return, we have to then assume that we're going to have to take on more risk. Well, do we really need that in our portfolio? That's a question that you should be asking.
Do you need it? Can you withstand it? So if you put your risk tolerance and risk capacity together, your investment objectives flow very naturally from that. And again, if market volatility, a natural part of owning market-based assets, if you are fearful and concerned about a level of volatility, that means that we need to start from scratch.
Let's talk about a year like this year. The S&P's up about 1% this year. It's positive 1% so far this year, and we're only through 5 months. You would have had to take on a 19% loss in order to get back to that 1% that we are year to date. So volatility is to be expected in stocks.
So how do you build your portfolio? One of the great portfolios, construction, if you will, is the balanced portfolio. And we've got an old balanced portfolio, the old 60-40 portfolio.
That's
that
right.
everybody seemed to use forever, which I think is worn out. It's not working as well as it used to.
Right.
And so the new portfolio, the new balanced portfolio, is roughly half stocks and half other assets. And the other assets composed of alternative investments, which we could talk about a little bit, some cash, and certainly fixed income or bonds.
That's right. And Roger, why hasn't the traditional, the old balanced portfolio, why hasn't it actually met goals when the rubber meets the road?
Well, if we look at 2022, it was a year when stocks and bonds both declined. So that's a year where they both went negative at the same time.
Right.
In other words, stocks went down, and it's a year when bonds should have been able to absorb some volatility, and they failed to do so. But there's a more subtle story here, a subtle story of correlations. Right?
Exactly right.
So the extent to which stocks and bonds move in the same direction have been rising over time. And the 60-40 portfolio depended on the fact that stocks and bonds did not move in the same direction. They didn't have a high correlation. Well, the fact is their correlation is much higher. Therefore, the 60-40 portfolio is not as good, it's not as efficient as it used to be.
That's right. And I think alternatives are a somewhat new thing to the portfolio. Is probably the last 3 or 4 years we've started to build an allocation there, but they're really not new assets at all. Typical alternatives are things like private real estate, private credit, even private equity. But traditionally traded stocks, but just in a different wrapper of something like a merger fund. These sorts of things can help really dampen volatility in a year like 2022. When that correlation just breaks down and you get, negative double digits on both stocks and bonds in a single year.
And one of the great strengths of the alternative investments that we are using in portfolios is they are not correlated to stocks or bonds. So they add a great level of diversification to that classic balanced portfolio, which is really an all-weather portfolio, for many, many clients. So in the end, when you have your investment objectives, it's a mixture of these various needs, if you will. The need for growth and preservation of purchasing power, that is, a return that beats inflation, some income. If you're retired, many of our clients are at or approaching retirement. They need to think about taking income from their portfolios, and then preservation of capital. That is the return of your money, not the return on your money.
That's right. And this is also important because, for years we had the federal funds interest rate hovering around 0. And here we are in the last 2 or 3 years starting to move to this environment where we can actually see income on fixed income. We can actually see income on short duration income. So it's been a different couple of years.
Well, at the moment, cash is no longer trash. It'll be trash again soon. And
some
when it
point.
and when it is, we'll rotate to other assets. But in a portfolio, just to give cash some credit, in a portfolio, cash does not fluctuate in value. Money market funds don't fluctuate in value. So at the moment, we have a money market fund which is yielding about 4%.
Right.
And has zero volatility. Well, that's a pretty powerful asset in any portfolio.
Correct. So, you talk about volatility. Volatility in a way is needed to have sorts of a positive return. You have to have some stronger positive years than other years, and unfortunately, with that, you're going to get some negative years. But like we're showing here, over the history of the S&P 500 stock market, 24% of the years have been negative. So you have to be able to have a portfolio that's going to not only weather through the other positive years, but is going to weather through those 24% of the down years.
Absolutely. And if the market just went up, it would engender risk taking, which is not healthy. The fact that the market does fluctuate in value keeps us, if you will, honest. So we can't assume that we're going to make money in retirement. So how volatile are markets, Jackson?
So markets really, the volatility can really be a product of a starting point. If for example we're entering the year of 2025, then we just saw years of 23 and 24 where we had over 20% returns on the S&P 500, and we just think that with the market priced as high as it is now, our forward-looking returns have to be somewhat less now because the market has risen so much. So we could see some volatility, and there's volatility for price reasons, there's volatility for geopolitical reasons, but we just think it all is going to combine to be volatile. But it just it means that we have to build an all-weather portfolio.
So surviving volatile markets, I love this quote. This quote you put in here from Howard Marks.
That's right. Do you mind if I read it?
Please do.
I love this quote too. Howard Marks is a famous investor, and he says, "Never forget the 6-foot tall man who drowned crossing the river that was 5 feet deep on average." And what he's saying in that quote is that, if you're 6 feet tall and the river's 5 feet deep on average, well, there could be parts of the river that are 3 feet deep, but there could also be parts of the river that are 7 feet deep or 10 feet deep. And if you're 6 feet tall and you're drowning in 7 feet of water, that's like managing a portfolio in a down year that doesn't actually mitigate risk to the downside. So you have to not only mitigate and manage risk in your portfolio in years where you can be above the water, but also the years where you don't quite meet the water level.
Really, surviving is about surviving the negatives. Everybody can survive good returns. It's surviving volatility, and that's what we're talking about. So the volatility in 2025, it has arisen as a result of new Trump administration and tariff policies, et cetera. But thankfully, we're able to focus on the markets and portfolios and essentially say, markets and portfolios are volatile. How do we manage portfolios from here?
Right.
How do we price volatility? How do we manage it? And how do we look, as the slide says, long term? So looking long term, very important and more difficult during periods of volatility. But I think long term is 10 years. 10 years. That's a as Buffett said, his holding period is forever. Maybe his forever isn't as long as mine, but because he's 95 or something like that. But the point is that, as we said, the media is trying to motivate you to look at the markets through a very short-term lens. And if you do that, it'll drive you crazy. And you'll do things in your portfolio that aren't healthy, that don't engender good rates of return.
Right.
You've got to look long-term, over the horizon, and ignore current market volatility, static emotionality.
Exactly. And if we look at a period like COVID in 2020, you know, who during 2020 wasn't freaking out, right? The shutting down of the global economy. You know, there's this terrible disease going around. Everyone's getting sick, and you know, the news again adds on to that kind of emotion about all those things. Well, if you look back at the first quarter of 2020, it's like a tiny little blip on the trend line of the S&P 500. So, you know, that was intense volatility that we experienced during that time. But we have to keep a long-term focus. You know, if we keep a long-term focus, then like we talked about, a year like this year where markets were down 20% at one point, well, if we stayed long-term, now the S&P is positive, and you know, we could potentially see a positive rate of return for the year, and you know, maybe the 10-year average.
So we have to be calm, as you say on one of these bullets. The most important quality for an investor is temperament, not intellect. I completely agree. You have to remain calm, and even somewhat detached from the short-term volatility that ensues in the markets. Now, this current slide says, hey, here's some indicators that maybe you're doing the wrong thing in your portfolio. Are you trading too much? Are you trying to predict the markets? Those are indicators that you're not tuned in correctly to long-term processes for making money. Are you focused on hitting home runs? And if you know baseball, if you try to hit home runs, you strike out a lot. Whereas if you hit lots of singles and doubles, you probably have a higher batting average, and it's a winning strategy. So if any of these says, hey, you're doing that, then you need to go back to the beginning as far as we're concerned and take a look at your investment objectives. Start building your portfolio and your investment objectives from the ground up.
Right. And I think the other important thing here too is, are your investment returns reasonable? What do you think that the market should be returning? And you know, that was that one slide. That's a great question for that one slide, is given where we are now, we cannot expect the same level of returns to just continue every year. We're not going to get 20-25% on the S&P every year. We could in any given year, but you know, it's not going to be that long-term 10-30 years that we're going to see that high of return. So we have to set expectations, you know, based on the volatility that we've seen.
Well, and you asked the question up front, should you sell out? And this is the definitive slide which talks to selling out, or the reverse, staying invested.
Right.
All right, so we've measured the market for about 87 years.
Right.
The S&P 500 stock index since 1928, as I recall, Ibbotson and Sinkfeld. It's a 10.7 average annual rate of return for stocks, which, as Jackson said, we don't expect to continue. But look at the slide. If you miss the 10 best days in 87 years, your return is halved. If you miss the 20 best days, you're less than 3%. And if you miss the 30 best days, you're at 1%. That's the reason to stay invested. That's the reason you can't predict the markets. You've got to have a portfolio that you can hold on to.
That's right.
And again, we believe strongly in the balanced portfolio that would allow most investors to stay invested and focused long term.
And time in the market beats timing the market. You know, like Roger said, if you're trying to time the market and you're out for the best 5 days or 10 days or 20 days, 30 days, next thing you know, your average return is just, it diminishes to almost nothing.
It's almost nothing.
So how does this impact you? You know, you might be thinking about recent news articles that you've seen or recent, shows that you've watched where it sparked kind of a question in your mind, or it's it's sparked kind of a reaction that you want to have to a market. Well, if you're already a client, feel free to come and talk to us about it. We'll have this conversation with you. You know, if Roger's your advisor, if I'm your advisor, come talk to us about it. And you know, if you're not a client, then you know, again, reach out and we'll talk to you about it. We'll talk to you how we're seeing markets, how we're viewing the balanced portfolio, how we're viewing retirement income, and all those things.
We've had a lot of success managing risk, looking long term in client investment portfolios, and working with clients on a comprehensive wealth management basis. If you're looking for an advisor that does that, please, there's a QR code on your screen. Go to our website, reach out to us, and talk about becoming a client of the Financial Consulate. And thanks for listening.
Thanks for watching.